So I'm going to talk a little bit about the European credit crisis in a context of what's been other recent credit crises that we've had in the last few decades. So one surprising thing is if you think back over the last 20 years, almost all of the developed countries in the world have had a major credit crisis now. So in the 90s, we had the late 80s and then throughout the 90s, and I guess continuing to now, the Japanese crisis, caused by a real estate and a stock market bubble that led to a banking crisis. In the US, we had a real estate bubble, which then subsequently led to a banking crisis. And in Europe, we have a sovereign debt bubble, it appears, that seems to be leading to a banking crisis and potentially also a break of the monetary union. So I want to talk a little bit about what happened in these past situations. So necessary conditions for a credit crisis: you need sort of a large macro-scale mispricing of credit. You need a propagation mechanism, so there's an initial shock, and then there's something that sort of propagates the shock and almost magnifies it. And this is often undercapitalized banks and bad risk management practices. And then I think third, there's a misrecognition of the core problem by regulators and central bankers who then use liquidity tools to try and fix a solvency problem. Okay, so let's just go back a little bit through what happened in Japan and in the US. So in Japan, in the real estate and stock market bubble in Japan started in roughly 1986 when the Bank of Japan decided to offset the Plaza Accord agreement, which Germany, the US, and Japan agreed to appreciate the yen. To offset that, the central bank decided to cut interest rates domestically. That then very quickly led to the Nikkei doubled in about 2 years, and then real estate values went up quite a bit. So part of the mispriced credit was caused by excess liquidity. Part of it was caused by, I think, extrapolation of past experience that house prices never go down. And real estate is good collateral because real estate values never fall. We also had bad bank problems in Japan, sort of false belief in effective regulation from people outside the banks. And then there's a failure to quickly write down losses. Japan didn't really deal with the bank losses until the mid-90s. In the US, same thing, we had mispriced credit. I would guess again it was due to the same things, excess liquidity, in part due to the Fed cutting rates in 2003 to very low levels and holding them there for a long time. Also the shadow banking system providing excess liquidity to the system. And then we had the same problem with real estate, that people thought home and land prices never fell and were therefore good collateral. Again, bad risk management at the banks, false belief that somebody inside the banks was doing their job. And then as soon as the crisis sort of started in 2006, the Fed stopped raising rates and started to provide liquidity tools, again, treating a solvency problem with liquidity measures. So I saw this quote in Greenspan's biography, which it's a good thing it was published before the crisis. So he said, speaking of the interest rate cuts in 2003, we were willing to chance that by cutting rates we might foster a bubble, an inflationary boom of some sort, which we would subsequently have to address. Well, you have to be very careful what you ask for. When you cut rates to inject a lot of liquidity and house prices take off, it may be hard to sort of stop the beast. If we turn to Europe right now, we can see these same conditions. So we have mispriced credit. I think this is largely driven by the EU, ECB, and markets' dogmatic belief that the sovereigns in Europe can't default. Trichet sort of held this belief until he left the ECB. So bad credits were able to borrow at very low rates. There was also a large increase in sovereign debt holdings after the US crisis by banks in Europe. Okay, so here's a picture of general government loans and securities held on bank balance sheets. So once the US crisis starts, starting in 2009, European banks increased by 25% their holding of government securities, a lot of which were Greek, Portuguese, and so on. Okay, I'm not exactly sure why. I wouldn't be surprised if regulators told them this wasn't a bad thing for them to do. And then you can see from the earlier presentations, there's some structural imbalances which are going to make it difficult for some of these credits to pay it back. You need a propagation mechanism. Okay, Europe, unlike the US, has always been a very banking-centric economy. So if you look at banking system assets as a percentage of GDP, I think we have big banks. We're actually over here, right, which is the lowest in the world. And then a lot of the problematic European countries are over here. And even a country like Germany, right, has a banking system as a percentage of GDP roughly twice ours. Okay. So the European banks sort of look like giant hedge funds holding lots of securities, holding not so many loans. And a lot of the securities they hold are government bonds. One nice thing about the US crisis is we didn't have this problem. So there was no sense that a sovereign debt concerns about the US government would cause problems at the banks. And the reason was, if you look at Treasury holdings, who holds the US government bonds, this little black line here are commercial banks in the US. Commercial banks in the US have never held very many US treasuries. What that meant is the US federal government could issue TARP and then effectively bail out the banks because there wasn't this tight relationship between them. And then in Europe, you also saw this misdiagnosis of illiquidity for insolvency. So at first, people just thought it was a liquidity problem. When Greece announced their problems, the first thing people did was said, okay, well, we're going to finance Greece, and you sort of fix the problems, ignoring the underlying economics that were indicating it probably was a solvency problem. And this also led to a failure of sort of, in the case of Greece, to default, and a failure to quickly write down losses. Okay, so at some level, this looks exactly like prior credit crises. Okay, and I just want to stop with a quote. So we have this quote that we often hear that those who cannot remember the past are condemned to repeat it. So there's two other ones which I think are maybe more relevant. So the first is from Bertrand Russell, that we learn from history that we learn nothing from history. Even though the people at the Fed and the people at the ECB had studied Japan, I assume people at the ECB had studied the US credit crisis, it seems like we're going through exactly the same steps again. And then the final quote is by a sort of famous psychologist. It's frightening to think that you might not know something, but it's more frightening to think that by and large, the world is run by people who have faith they know exactly what's going on. So in Emmy's talk, in the US, we were fortunate in the late 1700s and early 1800s to have Alexander Hamilton, actually I think a graduate of Columbia. He was one of those rare regulators that seemed to understand absolutely everything and know all the pieces. And he was able to make the good decisions to decide what to do, which subsequently sort of led to the, I think, the strength of the US. It's not clear to me that either at places like the Fed or the EU or the ECB that the regulators, the people in charge, really have a grasp of the problem. And at some level, that's the truly scary thing, because despite the fact that we're repeating the same steps that other well-established rich countries have gone through recently, for whatever reason, we can't stop ourselves from going down that same path.